we should probably be 150, 175 basis points lower. So, I think the committee needs to step back.
Hello, everyone, and welcome to the Week Ahead on Nomura Podcasts. I'm your host this week, Dominic Bunning, head of G10 FX Research here at Nomura in London. Well, we're in the middle of a heat wave here in the UK, and things are also hotting up in financial markets. The most potent pressure point right now is regarding the US Federal Reserve. Politicians, including US Treasury Secretary Scott Bessent, as heard on the Bloomberg TV interview there at the top of the show, are starting to put more pressure on the Fed to cut rates. We've also seen a lot of discussion about who might join the Fed Board of Governors in the months ahead and how that and changes at the BLS might impact policy in the future. We'll discuss this and the latest inflation data with Ruchir Sharma from our US economics team, who will explain why we have modified our call on the Fed funds rate. Elsewhere, it's been a busy week in the UK with a hawkish Bank of England decision and inflation data due next week. George Buckley will outline his views on these matters, as well as the Riksbank decision in Sweden, which is coming up, and the latest measures of European growth momentum. We'll also be discussing developments in China with Jing Wang following an extension to the US trade truce, some export taxes being placed on US chip sales to China, and broader geopolitical risks. Overall, markets have actually been fairly benign despite all of this back and forth, with equities continuing to edge higher, the dollar largely in the middle of its recent ranges, and US yields bouncing slightly from their post-payrolls low earlier in August. So plenty to talk about. Let's get stuck in.
If we'd seen those numbers in May, in June, I suspect we could have had rate cuts in June and July. So that tells me that there's a very good chance of a 50 basis point rate cut.
Well, we just heard there from US Secretary Scott Bessent from Bloomberg TV talking about his potential view on US rate cuts. So what better place to start than with Ruchir Sharma, one of our US economists, who'll talk us through how our view has also evolved. Ruchir, thanks for joining me again. Let's start on the data, though. We've obviously had some interesting inflation developments in the last few days. How have you guys been interpreting what's been happening on inflation?
Hey, Dom. Yeah, so this was the inflation week, and we had the July CPI and PPI. So core CPI actually came in pretty close to our forecast, but overall details suggested that tariff-related price pressures, they didn't intensify in July. So prices for core goods rose, but some of the tariff-sensitive components, such as appliances and computers, they actually fell in the month. So services, I'd say, was somewhat concerning, and actually Chicago Fed President Goolsbee categorized it as pretty bad, but it was mostly airline fares and dental services, which actually that drove the upside surprise, and they don't particularly feed into the core PCE calculations, which is essentially the Fed's preferred metrics to gauge price pressures. We had the PPI report as well, which suggested again that there were some of the components that were hot, like portfolio management, likely reflecting higher stock prices. But what's important is there were lots of hits and misses, and there are too many components to pass through. But the most important thing is that core PCE inflation, it's tracking at 0.3%, but the core goods prices, they didn't rise as much. So based on that forecast, we think, again, inflation risks are skewed to the upside, but it's still tracking the Fed's forecast of 3.1%, the one that they penciled in the June SCP.
Okay, great. And as you've hinted at, some of this softer inflation data has led you guys to change your forecasts. I guess you're not yet ready to join Scott Bessent in calling for a 50 basis point rate cut in September, but how are you thinking about the Fed now?
Yeah, so we did revise our Fed call, and we think that the FOMC will cut 25 basis points at the upcoming September meeting. So again, inflation risks are skewed to the upside, but as I said, that with core PCE tracking the Fed's forecast, we think that the policymakers could actually deliver the June dot plot. So if we look at the data, similar to what Fed's Kashkari mentioned, what we have seen is there's a sharp deterioration in employment and actually less inflation pressures than we previously feared. And at the same time, we think that the case or the bar for a supersized or a 50 basis point cut, that's still pretty high. So because there are still no signs of widespread layoffs or acute stress in financial conditions. In fact, the SF Fed President Daly said that, and she's been relatively dovish. She said that a 50 basis point cut would actually send unwarranted signals to the market. So that's why we don't expect the supersized cut.
Yeah, thanks, Rishi. It does seem like the hurdle to that 50 basis point cut is probably relatively high at this stage. But, there is increasing political pressure, as we discussed, on the Fed. We've had the appointment of Stephen Miran as a Fed governor, or the proposed appointment of Miran as a Fed governor. We've had this announcement of EJ Antoni to head the BLS, sort of both figures associated with the Trump administration in some ways. This has definitely raised some of the questions around, potential risks to the institutional credibility of these organizations. How do you and your team think about that institutional framework? Are we really at risk of seeing these become much more damaging changes, or do you think we'll sort of just crack on as we always do in financial markets?
Yeah, definitely there's a big risk, and we've seen the administration has been continuously pressuring the Fed to lower rates. And as you said, Trump actually nominated Stephen Miran to serve as the temporary Fed governor following Kugler's resignation, and we also saw the nomination for EJ Antoni as the BLS chief. Now, both of them, according to us, are partisan nominations. So talking about Steve Miran, we think that he's gonna be an extreme dove, and he's continuously argued that tariffs do not lead to inflation. He's at times criticized Powell for his reluctance to ease, and he's also criticized the institutional framework of the Fed. He's proposed several unorthodox options for the Fed to actually depreciate dollar. And talking about EJ Antoni, again, before his nomination, he did mention that the NFP report should be suspended until it's corrected, and definitely this aggravates fears around data integrity, and this is likely to cause doubts about things going forward. But specifically about the BLS, because they come up with so many revisions and methodological changes, and it's watched so closely. So we think that if data leans one way or the other, and if there are certain changes that are clearly partisan, it would be clear. And given all of these nominations, and we have also heard a lot of names doing rounds for the Fed chair, there's definitely some credibility risk. And in fact, most of the FOMC participants, they've flagged the risk, and all of them have unequivocally said that Fed's independence is critical to achieve their dual mandate. But given all of these nominations, there's definitely a risk that we cannot rule out.
Yeah, and I think you see that very clearly from the FX side, at least where I sit. The dollar has been under some pressure, albeit periodically when some of these announcements get made. We still think that the biggest driver of the dollar is going to be the cyclical story and that potential of pricing in of more rate cuts. But yeah, I think certainly a risk here that some of those institutional frameworks do get undermined, and that sort of undermines some of the investor the investment criteria for why you might hold US assets. So definitely something to watch. Not something we're super concerned about right now, but definitely something that could become more challenging. Thanks a lot for your time, as always, Rishi, and we'll catch up with you soon.
Thanks a lot for having me.
Well, we're going to head over to Hong Kong now, where I'm joined by Jing Wan, one of our China economists. Jing, thanks very much for joining us on the show today. I think a lot of what's going on in China, you've kind of got two things. One is the trade story and what's happening with the US in terms of geopolitics. And then the other side is the local economy. We haven't had a sort of China speaker on the call in a while, so I thought it was a good time to get an update on both of these things. What's the latest on the trade sort of side of things? I know we've had an announcement of a trade truce for a certain period of time. What is actually going on there, and how is it impacting the economy locally?
Yeah, thanks for having me, Dom. Yeah, it's great to be back at this very interesting time. I haven't been here for a while. Now, in Hong Kong and China, the market is getting more interesting, especially we are having a boom in the stock markets right now. Yeah, so first on this, U.S.-China trade tension. Yeah, clearly we are seeing more confirmation of de-escalation. Early this week, both sides agreed to extend the tariff truce by another 90 days until November. And I'm sure this is not really a big surprise to markets, considering the expectation building up into the deadline. So with this extension, now we are going to continue to have this 10% baseline reciprocal tariff and also 20% fentanyl tariff. Then the question is, how will the U.S.-China relation develop from here? I guess we just want to make 2 points here. First, we think both upside and downside to this U.S. tariff on China could be limited. On one hand, China is having the rare earth and the powerful bargaining chips, and on the other hand, especially on the fentanyl, it looks like the U.S. government still want to see more progress on this fentanyl flows. A second point we want to make here is the leaders of two countries are still very likely to have a summit sometime in the coming months. So it might be the interest of both sides to manage the tensions. So you can see, we are not that bearish on the U.S.-China relation, at least in the near term.
Okay, interesting. Thanks very much, Jing. So the trade side isn't too bearish, but I did note that a couple of the sort of economic indicators, inflation, loan growth, some of these things do still seem to be disappointing. In terms of the domestic macro dynamics, how are we thinking about that? Is it still quite a challenging period? You mentioned the stock market sort of booming, but is that not really a great reflection of what's happening in terms of the actual macro backdrop?
Yeah, definitely. Even we are having this trade escalation, but we still expect a sharp growth slowdown in the second half of this year. And just let me elaborate why we are thinking so. First, the tariff remain quite elevated. We estimate the average U.S. tariff on China is still about 40%. And now the U.S. government recently announced that any transshipment to the U.S. will be subject to a 40% tariff. Right. In addition, now since this month, the reciprocal tariff on all the U.S. trading partners have become effective. That will disturb the global supply chain and having a negative impact on China's exports. Second, China's consumption is still under pressure, as you mentioned, the inflation. If you look at CPI, it's still like 0%, right? And there is no big change at all. And we think the consumers will still feel reluctant to spend in China. And we are seeing the consumption will be weighing on the payback effects of this trading program and these new austerity measures. These new measures was introduced in late May and is meaning to restrict those excessive spending by the Chinese government officials and SOE managers. We have already seen the impact on this catering services and the retail sales of alcohol and tobacco. The third headwind is from the very recent anti-involution campaign. So this campaign aims to end the deflation in China through the supply controls. But definitely, if you tighten control, that will hurt your investment and output. And we also at the same time see some regulatory tightening measures as well. Starting from the September 1st, the enforcement of Social Security tax collection will be significantly tightened. And this is not really expected by many corporations, especially for the small business. So we expect some negative impact on the employment and also the profits of those companies. Last but not least, China's property sector is still declining, and it's entering its fifth years of correction. The decline in home prices just continue to worsen, especially in the big cities, right? So that because property contribute about 60 to 70% of China's household wealth, falling housing prices were definitely bad for the consumer sentiment. Yeah, so clearly you can sense that we are still very cautious on the growth outlook in the second half of this year. And actually, if you look at the latest July activity data, which also showed a worsening across the board and well below market expectations.
Thanks, Jing. So yeah, not quite so uplifting there. But is there anything on the agenda in terms of more proactive policy to turn things around, or do you think kind of there's too many other things going on at the moment, or the government actually, as you say, almost wants to curb some of that consumption? Are we going to get anything to see a rebound, or is it sort of still going to be quite challenging for the months ahead, regardless?
Yeah, so we have already seen some policies being announced in the recent months. For example, the announcement of the mega infrastructure projects in the western part of China, and this non-awaited national child care subsidy program. And very recently, the Chinese government just decided to provide interest rate subsidies for the consumer loans and the services business. But those policy measures we think are just far from sufficient to avoid a sharp growth slowdown in the second half. And we believe the Chinese government will very likely to introduce a new round of supportive measures as we get into the latter part of the second half of this year. And we just continue to believe the property sector is still the key to stabilize growth, to restore the confidence in the economy. But so far, we are still haven't seen much follow up in this regard. Yeah, so I guess this we think this is not the time for the markets and the Chinese government to be complacent.
Okay, fantastic. Thanks very much, Jing. Lots to look forward to, or lots to watch, at least in China, over the months ahead. Good luck, and we'll speak to you soon.
Thank you.
We'll finish this week in Europe with George Buckley, our chief UK and Euro area economist. George, thanks for coming on again. We've had a pretty exciting week, actually, in the UK. We had a Bank of England decision which seemed quite hawkish on Thursday last week. We've had a fair bit of UK data, and we've got a fairly important UK CPI release next week. So in terms of all things UK, why don't you talk us through what you thought about the central bank, what you thought about the Bank of England rate decision, and what you think about the data that's been coming out and is set to come out next week?
Sure, thanks, Dom. And yeah, absolutely. The Bank of England decision was very hawkish. They only just decided to cut interest rates. There were 4 members, of course, who voted for no change. And we had to have 2 votes, but that's largely because the cut vote was split. But the point is, it was close. And it does raise the risk of, or raise the question, are they going to go again? We think they will, because they keep signaling it. They're still telling us that rates are restrictive, and they're telling us that they want to cut cautiously and gradually. So I still think they go, but one thing I do think they'll need to see is some inflation prints which are lower, because we have had services inflation look very sticky. And that is a nice sort of segue into what we'll get next week, which is the CPI print. A lot going on within that CPI print. I don't actually think we're going to see much of a difference in headline CPI relative to where it was previously. So we're still looking at just over 3.5%, around about 4.5% for the RPI. But the key thing to watch in this report is going to be what happens to service sector inflation, the momentum in service sector prices. Are we seeing any slowing from what has been a slightly accelerating trend recently in seasonally adjusted terms? So that's going to be the key thing to watch, because we're really going to need to see that to get the Bank of England to keep on cutting interest rates.
Okay, really interesting, George. Thank you very much. I mean, the other central bank in focus this week is going to be the Riksbank. Probably not quite as exciting as the BOE was last week. We just had the Norges Bank, this week as well, where they left rates unchanged. Riksbank, we think it's going to be pretty similar. But are there any nuances that we're looking at in terms of the Riksbank rate decision?
Well, once again, it's a combination of growth and inflation, which is really going to be important here for the Riksbank. We've had a bit of up and down on the economic data over the last couple of months. As we get towards the end of the year, what we're expecting is that growth will recover, but at the same time, inflation will move back towards its 2% target. Some of the inflation prints we've had recently have been a little bit stronger than the Riksbank would have liked. That's going to preclude a rate cut in August. And we think that when inflation does start to move back, that's not what they're going to be focused on. They're going to be focused on the fact that growth is recovering. So all in all, we think the Riksbank's done, and they're going to stick rates and keep them on hold at 2%.
And I think that's quite important, actually, from a market's perspective. The market's had quite a dovish pricing for the Riksbank, and obviously, as we think that's not going to play out, we've been quite positive on the on the Swedish currency as well in the last few weeks, looking for dollar stocky to fall over the period as well. So I think quite an important sort of guidance from the Riksbank in terms of market implications. I guess Europe's been a bit quieter, but we do get PMIs at the back end of next week. How are you thinking about the European situation at the moment?
PMIs really important because they do correlate pretty well with GDP growth. Now, GDP growth has been weaker in the middle of the year, going from a strong print in the first quarter to a much weaker print in Q2. The PMIs will be pretty important in informing our view of where growth is going. These figures are very crucial to watch. We think there's a risk that they could come down, and one of the reasons for that, or two of the reasons, should I say, are the Sentix survey and the ZEW survey. The Sentix, as it really says on the tin, is a sentiment survey. So the PMIs asked the question about what's happened to output between 1 month and the last, rather than sentiment. So it may not be the case that lower sentiment necessarily means a weaker PMI, but I think certainly the risks might be on the downside based on the survey evidence that we have so far, at least for the euro area. Whether that seeps into the UK numbers or not is questionable, but certainly I think there are downside risks on the euro area PMIs.
Okay, interesting. That's quite notable, given we've obviously got a bit more clarity in theory on trade in Europe, but I guess there's still a bit of uncertainty regarding geopolitics. We might find out a bit more as this podcast comes out around what's happening with Russia, Ukraine. But certainly Europe, it's not all bright, although maybe there are some upward signs to keep an eye on. Thanks very much, George. Really appreciate your time as always.
Cheers. Thanks, Dom.
That's all for this week. Thank you, as always, for joining us for the Week Ahead podcast, which was edited and produced by John Dalton. We'd love to hear your feedback, so please do feel free to like, leave a comment and subscribe to Nomura's podcast on Apple, SoundCloud, Spotify, or your usual podcast provider, and share today's episode with anyone you think is interested in the latest macro and market developments. You can also check out nomuraconnects.com for more of our research and updates. Thanks again, and good luck for the week ahead.
In a complex and unpredictable world, where a sunset in one market means a sunrise in another, one investment bank always looks beyond the horizon to help our clients release the potential of tomorrow, today. Nomura, connecting markets, east and west.
Disclaimer. This content has been prepared by Nomura solely for information purposes. It is not intended to form the basis of any investment decision, and is not an offer or solicitation of an offer to buy or sell or enter into any agreement with respect to any security, product, service, including but not limited to investment advisory services or investments. The opinions expressed in the content do not constitute investment advice, nor is legal, regulatory, accounting, or tax advice, and may change at any time without notice. You should seek independent advice as appropriate for individual circumstances. For further information, disclaimers and disclosures, please visit Nomura Connects at www.nomuraconnects.com.